right, I think we're going to go ahead and get started. Thank you for joining us today. Wealthstream Advisors webinar on building PwC partner benefits into your financial planning. I am joined here today by Joe Orff, who's a senior advisor here at Wealthstream Advisors and our director of investments, as well as Eric Siss, our also senior advisor and director of financial planning. My name is Matt Gordon. I am also a senior advisor and I am director of education here at Wealthstream Advisors. We're delighted to have you join us here today. Can't think of two better people than Joe and Eric to discuss some of the PwC specifics that we have to review as it relates to financial planning. Just briefly, one bit of housekeeping is that we will be not taking live questions during this webinar, but if you do have any questions or anybody wishes to follow up with us, we'd be delighted to hear from you. And we'll have our contact information available in the chat. And you can also always find us at our website, which is wealthstreamadvisors.com. Just briefly about Wealthstream, we are an independent registered investment advisory firm, roots dating back to 1996. 12 years ago, we had the good fortune of being introduced to a PwC partner. He was fresh off of a sabbatical, and that was a terrific introduction because it gave us a crash course into the challenges and the opportunities that PwC partners have, as well as all your acronyms we learned about. And we helped that partner through retirement. They're happily retired now. And we've now had the good fortune of then working with a number of other PwC partners who I think really appreciate that we didn't have to be brought up the learning curve because we've already got a sense of how things work with your organization. So let me start with you, Eric. When it comes to one of the major decisions that a partner has every year, it's around how to allocate their year-end distributions. What are some of the things that you think about as it relates to that?
Yeah, it's a great question, Matt. I think it starts with acknowledging that a partner's year-end distribution typically represents a fairly large portion of a family's income. So there's definitely some psychology at play. I think there's a real tendency among partners to just do nothing. One, because the PDP pays such an attractive rate. There's a sense that, how do I time the market, or when is the right time to get into the market? Or the other thing that we see is some partners are just generally apprehensive about navigating PwC's very strict compliance. So I think a lot of people just kind of wait on the sidelines. For us, what it comes back to is making sure that you have a plan, and a plan in advance of getting your year-end distribution. So for us at Wealthstream, we're big fans of bucketing for different goals, and that helps partners identify not only which account they're going to put their distribution in, but also how much risk they're going to take, and marrying that with the time horizon and their own risk tolerance for the investments. So I think it always starts with the PDP. You always want to make sure that you have enough in emergency reserves. You want to make sure your quarterly estimated tax payments are set aside. And then anything that's in the short-term goal horizon, we're also having a bias to keep that in the PDP as well. From there, we like to design a dollar cost averaging strategy that helps take a lot of the emotion out of getting into the markets, and then create a systematic plan to be able to really act on the year-end distribution.
That sounds good. So, Eric, I know maybe you could pull up a visual that I know that we have for the wealth life cycle. And as you pull up that visual, I know that the things that we think about with financial planning is from wealth accumulation all the way down to transfer of wealth to future generations. But just dealing with the accumulation side of wealth, help us take me through kind of what you think about for a newly minted partner all the way through somebody that's, really right at retirement.
Yeah. So I'll share that visual here in a second. And I think broadly what we're talking about for individuals is they fall into one of these four buckets. You're in the accumulation phase, you're in the wealth preservation phase, you're in the decumulation phase, or you're in the wealth transfer phase. And each one of those has unique challenges and unique planning opportunities. But really what we focus on mostly for PwC partners in their working years is that accumulation phase. So while a lot of the strategies that we'll discuss today are on the accumulation phase, just know there's a lot of things we probably won't talk about today that you might be thinking about in your planning. So Matt, as you alluded to, there's a couple different phases even within the accumulation phase. For newly minted partners, I think people often look at the new alphabet soup of available options and they're wondering what they should be taking advantage of. But for us, again, I think it's okay to hoard cash for a little while. I think that for new partners, it's coinciding with a lot of other events in their life. You might be buying a house, having children, looking at a potential second home or vacation home. And it's also a very demanding time in your life in terms of career. So having a little bit extra in cash allows you the flexibility, maybe for a spouse to take time off, for you to transition to a different office in the country, or just generally have the optionality and the flexibility to like go where your life takes you. I think, as we work with partners who are more in the peak earning years, some of the things that we're thinking about are not only on like the PDP specific risks that start to come into play, where partners have a lot of money in firm balance sheet type assets. So as partners who come to us, they typically have a lot of money that are in these plans. So what we try to do in that regard is start building out the other portions of their balance sheet, whether that means taking advantage of HSAs, Roth accounts, or even building laddered treasuries or municipal bond strategies to help make sure that there's more diversification on the balance sheet. And then as we start to work with partners who are approaching retirement, that's really where we start to focus on things like the AAP and additional tax deferral. And if we've determined through our work together that you've accumulated enough assets to do the things that you want to do in life, usually then is where we start to talk about some of those wealth transfer techniques and gifting strategies.
Thank you. Are there any common themes, Eric, that you say you observe regardless of where somebody is?
Yeah, I think the common themes are, you probably hear a lot of chatter around the office of what this partner is doing or what that partner is doing. But I think the real common theme is what they're doing might not be right for you. You really have to pay attention in your own financial planning, what's best for you and your family. So just because you hear somebody's taking advantage of an AAP, maybe it's not the right time for you. I think the things that you should focus on are making sure that you have liquidity to do things that you want to do, that your balance sheet is diversified, that you're keeping your costs low, and that you're really focusing on the things that you can control within your tax planning. And I know Joe's going to talk about this in a second, but making sure that you're not shying away from investing and that you can invest in a compliance approved way.
Thank you. So let's not shy away from investing. Joe, why don't we start on the investment front and talk to me about the PDP? How do we view that?
Yeah, absolutely. So first off, we know that all partners have a different level of comfort with the PDP program and the inherent unfunded nature. I'm going to focus more on the specific investment of the PDP. The yields that PDP pay are attractive. There is no doubt that those rates are attractive. With 5-year term currently is paying over 8%, 2 years about 7%. Those are attractive yields. As Eric mentioned before, a lot of our partners' cash reserves, we recommend keeping in the PDP demand. That's an equivalent to a high yield savings that they can earn higher yields on. Then to the extent that we start thinking about the term PDP, we actually view building out a fixed income ladder within the term PDP from 1 to 3 years as part of a client's overall asset allocation based approach.
So with PDP being tied to prime rate currently is 7.5%. Why invest in anything else?
The reason why you invest in anything else other than PDP is because we focus on after-tax return. So the 5-year PDP is paying 4.9%. And before someone jumps the gun, that is the after-tax rate of return using 37%, the highest federal income tax bracket. It brings that 8.35% pre-tax to 4.9% after-tax. And that, don't get me wrong, that is still an attractive rate of return, but it shouldn't be your entire investment portfolio. When we did an analysis and we looked at the last 10 years of returns, we compared the 2-year term PDP, since that's been around the longest, and we assumed that you continuously stayed invested for that 10-year period. We assumed you put in $1 million 10 years ago. We ran the same analysis versus if you put $1 million into just the global stock market index. We calculated, the after-tax return of those two buckets. And after a 10-year period, the $1 million in global stock market was higher by about $836,000, $539, versus the PDP on an after-tax basis. A lot of that is due to the inherent nature of you can control your taxes much more investing in the global stock market index, because unless you're forced to sell, you get a lot of the benefits of not paying a forced tax like you do on the PDP.
Well, forced to sell is sort of the compliance concern. So that there is a reluctance sometimes to invest in stocks because, how can we ensure that we're building a stock portfolio for a PwC partner that stays within their compliance rules?
So we are plugged into your checkpoint system. Over the last decade plus of working with partners, we've been able to review and vet a number of improved investments that we've been able to build out a very diversified portfolio that's compliance approved for all of our partners. We thought about it a little different than maybe some other shops. We actually didn't want to just stick with one fund manager for all the asset classes, because we think that's a real risk that if there is a new compliance concern with one company and that's your entire equity portfolio, you'd be forced to fire sale everything. So we diversify across managers for that reason. The other big value add we add on the compliance is we take it off of your hands. We work with your compliance team. We get your accounts uploaded to the checkpoint system. We pre-approve investments. And that allows you to focus more of your time on things that you like to do. And after working with a number of partners, keeping up to date on checkpoint and making everything compliance approved isn't their number one favorite thing to do.
Mm-hmm. Joe, why don't you speak some more about our investment philosophy here at Wealthstream Advisors?
Yeah. So we are not stock pickers. We don't believe that you can perfectly time when to buy something and when to sell it. You really have to be right twice. And a lot of data points that that's very, very difficult to do. So how we invest is focus more on the long term. And what I mean by the long term, and I'll bring up this chart here. This looks at a simple S&P 500 index, and it looks at the returns from 1990 to 2023. And it shows if you were invested the whole time versus if you missed a few of those single best days. And it's pretty stark. If you miss 25 of the single best days over this period, your annualized returns about half of what it would have been otherwise.
Something like going from 10% down to 5%.
Exactly.
Right.
The only way to have those types of returns is to be able to handle these downturns. So this graph shows the past 20% or more declines, how long that decline lasted, and then the bull market subsequent to that decline. So in order to get that average return, you have to be comfortable with your investment strategy to handle these market downturns. One way we try to smooth out these downturns as best as possible is to globally invest. We won't just invest in the S&P 500. One reason being this lost decade slide here. You can see over a 10-year period, the S&P 500 had a negative 9% total return. Every other asset class was significantly positive. So at Wealthstream, we try to smooth out the return which means that in any given year, you're not going to be the best performing asset class, but you're not going to have the worst performing asset class either. And that's what we're trying to achieve.
Thank you. And if anybody wants to see more about those slides, they can always ask us. We're happy to share. So Joe mentioned something about taxes was related to the PDP, and Eric, as we know, our PwC partners, they're high earners. So what are some of the tax strategies that we like to bring to their attention?
Yeah. So at Wealthstream, we're focused on not only having our clients pay the lowest tax they can today, but also the lowest tax over their lifetime. And sometimes that leads to some counterintuitive decisions. And one of those is focusing on Roth accounts. So I mentioned before about the incredible tax deferral opportunities that PwC partners have. So I think the situation we've all found ourselves in is prospective client comes to us nearing retirement and all of their assets are in 401k or tax deferred vehicles, and then they're getting ready to start their PRP. And the implication of that is when you need cash in retirement, there's really nowhere to hide in terms of taxes. So if you had a big distribution that you needed for, a second home, for instance, you're really going to be paying the full purchase price plus extra in taxes. So what we've worked with a lot of partners on is actually switching over their contributions from pre-tax to Roth, even though they're in their highest earning years, because their balance sheet determines that it would be a good decision long term. And what that also helps you do is it helps insulate you from potential future changes in tax law. So should tax rates go higher in the future to make up for some of the deficits that we're seeing today, those Roth accounts aren't going to be subject to that risk, whereas your qualified accounts would be. So that's one of the techniques. I know partners are generally aware of the mega backdoor Roth contribution. If you're unaware or first time hearing about this, please reach out. We're happy to walk you through it. But even outside of the backdoor Roth within your 401k, I think a lot of partners also look at the backdoor Roth IRA and say, those are small dollars. It's $7,000 a year. But we push back on that. It's $7,000 for you, and if you have a spouse, it's $7,000 for them as well. And we have partners where we've done this for 15, 20 years, where now they're looking at hundreds of thousands of dollars in completely tax-free money that can potentially be used as a wealth transfer vehicle if they have those goals. So Roths are a really big thing that we work with on our clients.
What else besides Roths?
Yeah, I think some of the things that have been really well received are our stance on HSAs or health savings accounts. I think a lot of people look at an HSA and they say health account, might as well use it for health expenses. But for that purpose, the HSA is a triple tax-free vehicle. You get a tax deduction on the way in, the assets grow tax deferred, and so long as you use it for qualified medical expenses, it's also tax-free. So what we push our clients to do, and we suggest, even if you have current year health expenses, don't spend from the HSA. Invest those monies, potentially invest them aggressively, and let them grow, because all people have some sort of health expenses in retirement. Medicare premiums are a qualified expense. So when you get to age 65, you have a source of outflows there for completely tax-free money. And then I think the other big one that is usually a winner with our clients is the charitable gift fund. So just to set the table, a charitable gift fund is an account that you can set up now, make current year contributions to, but you're in no way required to distribute them in any given year. So we've seen partners who, accept a promotion. They were in a previously pre-approved investment, and then all of a sudden they have an investment that's no longer pre-approved and they have 2 days to get rid of it. And a strategy that's worked well, provided you're charitably inclined, is to move that money into a charitable gift fund, get the deduction, not have to realize the sale, and then you can drip that out over time. And to the extent that it's a large amount of money, charitable gift funds can also be invested in another tax deferred way. It's no longer your money, but you could still grow your philanthropic goals over the long term. And to the extent that you're interested, you could also get family members involved or set them up as a potential endowment-like fund for after your passing. So those are really, really popular ways that you can do some tax planning.
That's great. And yeah, a charitable gift fund also goes by the name of donor advised funds. If people are curious. You mentioned other people in the family. What are some other things that we think about for planning for children? Like some of our partners have high school, college age, or even in their young 20s. What are
Yeah.
some techniques?
You mentioned this in the beginning. It depends which phase you're in the accumulation phase. So some of these strategies might make sense for you, some of them might not. But I do think that a lot of our partners are excited about the prospect of helping their children. So uh, again, this could be probably a whole nother webinar. So I'll stay high level and again, reach out if you have questions. But there's this concept of using your annual exclusion gifting. So you can use $19,000 per spouse or beneficiary and not have to worry about gift tax implications. So for people's children, that typically takes the form of a few accounts. One is 529s, which are college funding vehicles. You have young children, or if you have older children in their teenage years and they're working summer jobs, a lot of our clients like to make Roth IRA contributions on behalf of their children to help them start planning for retirement or even have skin in the game when it comes to investing. And a really popular one, which might be lesser known, is if your child is no longer dependent on your tax return, but they're still on your health insurance and you're eligible for the HSA, they're also eligible for the HSA. And the interesting part about that is the family maximum contribution for an HSA is $8,000, but that applies differently for the client and spouse and their children. So the implication is, client and spouse can have an $8,000 contribution to the HSA, and that does not impact their children. If they have multiple children who are in this circumstance, they can make $8,000 gifts to the HSA for each of them. And then beyond that, I think this is really where we get into some wealth transfer. If we work together and we've determined that you don't have need for the capital, you can start shifting assets outside of your estate through creative trust planning, using that same annual exclusion gifting. And I'll leave it there for now.
Great. Thank you. Thank you, Eric. So let's talk about retirement planning. And Joe, the age-old question that we get, will I have enough to retire comfortably? How do you respond to that?
Yeah, this is my favorite question. It's the easiest to answer. The answer is it depends. No one seems to love that answer, but it truly does depend. It depends on your personal circumstances. It depends on how much you want to spend in retirement. It depends how much you would like to spend in retirement. It depends if you have legacy goals. There's a number of different things that affect that calculation. One thing at Wealthstream that we do is we work with all of our partners to create hypothetical cash flow projections where you look at all of their income and all of their expenses and see, do you have enough assets lasting till your age 100?
So and speaking of like those cash flows, I know that Partner Affairs Department at PwC does a terrific job. Some of the retiring partners right now, as we speak, I believe, are in a retreat. So, leading into the last couple of months before retirement, what are some of the things what are some of the details to get locked into place?
Yeah, one of the biggest planning elements is really around the PDP. If we know when a partner's likely to retire, we can strategically have a number of PDP term plans mature prior to retirement, because on your last day of working, you have one last ability to add funds to the term plans. It's at this point that we really start to look at the 5-year term as a really good option, because typically at this point in a partner's life, you have suitable cash reserves. You're going to start receiving the PRP, other income sources. Locking up money for 5 years as a fixed income component can make a lot of sense.
Great. And then on the PRP, how does one choose between taking the single life versus a joint survivor, and what percentage goes to spouse? What are the thoughts there?
Mm-hmm. So we look at what the payout structures are for the single life versus the joint. And we don't just stop there. We also look at any existing life insurance policies, either through PwC, whether there's some cash value and you can buy a paid up policy to cover a loss of the pension income. We look at other term policies that you might have for a number of years after retirement. And what we like to show the clients are several options for if you take the single life option, your spouse gets this benefit. Is that enough for your projections? If it's not, maybe you take the joint and survivor and some sort of mix and match. It's one of the most fruitful conversations I'd say we have with our partners because it's such a big decision.
Right. So why don't we, I want to just wrap up and come full circle. If you can bring up the visual that we have. So one thing I just want to mention personally, that as I mentioned, with partners that had taken a sabbatical, we at Wealthstream have instituted a sabbatical program here as well to mimic what you do, because we see how great that can be. I personally will be taking a sabbatical in 2 weeks. We'll be taking pretty much the month of April off. So we get that there's more to life than just the numbers, and the financial, aspects are really there's a means to it, or there's a goal in mind. And we love to hear your stories. Well, what your sabbatical story is, or how you want to plan for your retirement and what that means in your life. And when it comes to thinking about Wealthstream Advisors and what kind of ways that we can add value, we can really summarize that with the 4 C's that you see on this screen. So I'll just say, like, the big letters: competence, being that we know, a thing or two about the tax planning, the compliance rules that you have. Really important that you have an advisor to help you that understands how everything fits together. On the second C, being coaching, is helping you to stay accountable. It might be kind of like your fitness instructor at the gym. You could do a lot of things on your own, but boy, it's great to have somebody as your advocate that's really there for you to see that you're doing things the right way. Continuity, you might know where all of the things are in your life, but does your spouse know? Do your kids know? So a lot of times people really see us as great peace of mind because we can bring that continuity for them. And the last one I'll mention is convenience, that a lot of times people find it just great to delegate to somebody like a Wealthstream Advisors, because there's paperwork that you have to do to open that Roth IRA for your child, let's say. Wouldn't it be great to have somebody that will do that for you? Wouldn't it be great to have somebody that will liaise with your compliance people to make sure that you're staying within the rules? So those are some of the things that we think about. We can touch on so many other things, but we wanted to just keep this within a 30-minute block. So we know you all lead busy lives, and we'd be delighted to hear from you. And we'll end it there. So thank you very much.
Thanks, everyone.
Thanks, everyone.